So if you really think this one through, another reason why, well, think of it this way. Think of Wall Street as a Walmart or an Amazon or a Costco, right? A major retail store like that. That's kind of what Wall Street is, right? When do they do well? When they sell their product at a higher price. So that's why that factor right there as well is another reason why the stock market is designed to go up over time. But it's this next one that a lot of people don't think about, and it is pure supply and demand. Okay, if you think about it, the amount of available stock is a finite number, meaning there is a certain amount of stock for sale out there, and that's it, right? Now, yes, there's new companies that come around. Some companies issue more shares, but for the most part, the amount of available stock for sale is a finite number. Now, it's a huge number. It's a massive number, but it is a finite number. What about the buying power for those shares? Is that finite? It's not. The buying power isn't, right? There are many different forms of money and credit, and all of that is being created and recreated all the time. Does that make sense? So what it does is it creates this big imbalance. One of the another example very related to this, and some of you may be aware of this, are stock buyback programs with companies. Have you noticed over the last few years how much stock companies are actually buying back? What does that do? That eliminates the inventory, or I should say reduces the inventory of stock available out there, creating more of a supply-demand imbalance, again, helping drive share prices higher. Is all this making sense? Am I losing anyone? It's important stuff because, when we'll get to this in a minute, but when we think about, a strategy out there to buy, when it comes to buying and selling in markets, why not, if there is a market out there that's designed to go up over time, that's a pretty big advantage, right? Right? Bigger picture, even as a, shorter term swing trader, why not focus on buying pullbacks to demand zones in a market that's designed to go up over time? Does that make sense? That's kind of the bigger point here. But if you really look at these 5 points here, and there's actually more, you can see why the stock markets around the world, unlike other markets, are really designed to go up over time. Okay? That is not at all to suggest that they are always going up and there aren't big declines in the market. There absolutely are, right? But those are always two significant demand zones, and from there, the market moves higher. I said this already, but make sure that your definition of buy and hold is proper. And ultimately, it's up to you, to choose that. But the conventional definition of buy and hold is buy at any price and hold with no plan for profit or loss. That's what most people do. If you look at the financial statements of most people around the world, that's what they do. They just buy into the market, regardless of where price is, and they hold these positions with really no or little plan for profit or loss. In other words, their financial well-being, as far as their positions in the market, just ebbs and flows with the rise and fall of the stock market. But it doesn't have to, that doesn't have to be your definition. That doesn't have to be your set of rules. You can also choose to buy at wholesale prices, right, or demand, with a plan for profit and a plan for risk. Make sense? Any questions, comments? Okay. Now, we can take this a little bit deeper. There's one more thing here. Well, I'll get to that in a minute. So overall, it's important to understand this as you develop your strategy rules, deciding what markets to trade, what asset classes to trade, and all that, right? Obviously, options are tied to this, and you can trade individual stocks, you can trade when I say trade, we mean trading, investing, right? Same thing. But you can, individual stocks, the indexes, index ETFs, equity index futures, sector ETFs. They're all different versions. They're all different ways to buy and sell in the stock markets. Okay. Now, let's take a look. So, as many of you know, I deliver sessions every morning at the Pinnacle Institute. And one of the things we started looking at last year, remember when in the United States, I know, most people in all these webinars are from all around the world, so I try not to speak from just a U.S. perspective, but in the U.S. here, if you look at historically, when the Fed starts raking, the Federal Reserve in the United States, the Central Bank of the United States starts raising interest rates, which they did last March 2022, and I'm aware of all this, so we started looking at this last March, which is almost a year ago now. A lot of people think, well, the stock market is going to go down or goes down. However, be careful with that thought, because if you look at the history here, yes, 3 months later, a lot of times the stock market is down, just like it was 3 months later last year. 6 months later, it's still down a little bit, but most of the time it's positive. But 1 year later, after the Fed starts its rate hiking cycle, at least during this period, the stock market has never been negative. Now, we're a little less than a month away from the 1 year mark. We're about a month away, I should say, from the 1 year mark. And the stock markets are negative, but not by much. And when you look at the Dow, when you look at the DAX in Europe, those are very close to all-time highs. So we'll see how this plays out. And if this stuff is important to you or means anything to you, let's add one more thing to this. When you look at the history of the S&P ending a year down 20% or more. Now, last year the S&P was not down 20%, but it was close. You can see typically the S&P comes, typically, not always, but typically the S&P comes roaring back. And the average increase for the S&P after a year of decline is almost 13%. And in most cases, the index goes on to a multi-year run. Now, a little bit different this time, when you look at midterm elections. So in the United States, most of you are aware, last year we had midterm elections. And when you look at that, the stock market has significantly outperformed after that, with the S&P gaining an average of 16.3%. And more specific, this is especially true in the first 3 months following midterm elections. So stock markets are up quite a bit this year compared to the close of last year. Now, you have to make sure you understand too, 2021 you closed right near the high. So 2022 was a down year, and 2022 closed close to the low of 2022. So we're getting a nice big bounce early this year, which is fine. And one last thing to think about is, I know we're all hearing all this talk of recession. What most people don't say is, the recession happened many months ago and has been over for many months. Now, could there be another recession? Possible, not likely. And at the end of the day, with all this information, right, and all this just stuff, keep in mind that, I'll go to the charts now, right? Keep in mind that at the end of the day, the focus is pure supply and demand. So I'm going to say next is probably the most important thing we're going to talk about today. And it's this. Understand that any and all influences on price are reflected in price. Okay? Meaning the supply and demand results the buying and selling result of all this information, all this news put together, which is impossible for anybody to really know it all and decipher it all and then make the right decision on it. Nobody does that, right? Even the smartest quants in the world can't do that. But the one place where all of this information is reflected is what you're looking at on the screen. It's the price chart. And that's why we have this razor sharp focus on supply and demand and only supply and demand. If you think about it, all the information we just went over and all the economic news out there, corporate earnings, all this stuff, right? There's so much of it. We can talk day and night about it. Between TV and the internet, 24 hours a day, 7 days a week, it's this massive information cycle of economic reports and news and all this stuff, right? Someone tell me this. Someone tell me this. You know, again, 24/7, you have sort of, you know, all of these every hour, right? You have on some financial or business TV or the news channel or the internet, you always have like at least two people talking about the economy or talking about the latest economic report. And they go back and forth. Well, the economy this and earnings that, and it's and often it's a Ivy League professor and a you know major well-known economist, and they're talking back and forth. One person's taking one side, the other person's taking the other side. Someone tell me this. What's the goal of all that conversation? All of this information overload and all of these discussions and opinions, what's the ultimate goal? What are they trying to, at the end of the day, what are they trying to argue and figure out? Someone tell me that. What is it? At the end of the day, what exactly, you know, what's the point of all that? And it's nonstop, right? It's literally 24/7. It certainly brings more fear and confusion, yep. But what's the point they're trying to get at? What's the main point of all of that talk? And it's a lot of talk, right? At the end of the day, it's this. Where is price going to turn and where is price going to move to? Isn't that the point of all this information and all this talk and all these opinions? Where is price going to turn and where is it going to move to? So when we talk about the supply-demand strategy, our approach is, instead of covering all and thinking about all this information, we just go right to the main question, which is, where is price likely to turn and where is it likely to move to? We ignore all that other stuff. Does that make sense? Because at the end of the day, all of that information leads to one of three things: someone buying, someone selling, or someone doing nothing. And we don't care about the nothing, but the buy or the sell ends up on the chart that you're looking at here on the screen. Does that make sense? Okay. It all ends up as a buy or a sell, and that shows us what the actual supply and demand is, and the supply and demand summary, right, of all of that information. Everybody's perceptions and everything else is reflected on the chart right here. Do we care why price is doing this or price is doing that? At the end of the day, it's just all about supply and demand. Does that make sense? And that's why, again, you see in these sessions, for those of you that are part of the Pinnacle Institute, we just have this razor sharp focus on that and only that. Just reading back in the chat here a little bit. Well, the reason why price is going up there, Kareem, is because there isn't enough supply at those prices to meet all of that demand coming into the market. Like right now, prices are falling because there's not enough demand at current prices to meet the amount of selling that's coming into the market. However, the footprint or the picture of a supply-demand imbalance, okay, and I have a closer one here for you. Let's actually go to, instead of looking at the S&P futures, let's go to the SPY, because most people can buy and sell in the SPY, right? So you can see this morning there was a gap up in price. We had some good news yesterday, right? We had we had earnings, and you had more corporate layoffs. Remember, corporate layoffs are very bullish for the stock market. So you had a lot of that and some good earnings. And to your question, okay, a lot of people perceive that as bullish stock market, so a lot of people push the buy button. If you look at the chart here, okay, this is where the stock market closed yesterday. And with all that good news overnight and after hours, there wasn't enough, there was too much demand coming into the market. So there was more demand than there was available supply at yesterday's close. So all these buy orders need to get filled. Where's the price where you can fill a lot of buy orders? At a price level where supply exceeds demand. So today, similar to yesterday, today we gapped up to and traded up to our qualified supply zone. Once the last news-driven buy order was filled, right, competition to sell its supply is pushing price lower. Now, the next qualified demand zone below current price is, I mean, we do have a little demand zone down here at 410, but this is just for more of a active trader. But if we go over here, show you, right? This is a very tested demand zone, worked well for us, but we're done with that one now. We wouldn't buy another pullback there. The next higher probability demand zone is down here. Okay? Does that make sense? So, you know, that's how, obviously that's how all this works, right? That's correct, Kareem. Okay. So, and I love what you're saying in the chat. So you're taking all that information and saying understanding fundamentals seems to be important. And what you're saying is, you know, despite trading just the charts and supply demands. So let me explain a little bit further. Really think about when I say any and all influences on price are reflected in price, really understand what that means. What that means is you take all of this fundamental information out there, and I do mean all of it. At the end of the day, again, it creates thoughts and perceptions for all of us, from the individual trader at home to the CEO of Goldman Sachs, right, and everybody in between. So all of this information leads to thoughts and perceptions for everybody. Those thoughts and perceptions lead to either a buy or a sell. Where's the one place where we can see all of those buys and sells? It's right here on the price chart. Okay? So, and that's what we mean by that. Now, right? So, again, any and all influences on price are reflected in price. That's what that means here. Do I know exactly why demand, you know, exceeded supply here at 294.70 in the NASDAQ? No. Do I care? No. Obviously, there was some good news that came out, and a lot of people bought. But the reality is, we know the only reason why price moves higher from this area is because demand exceeds supply here. If that statement was not true, then price would just keep trading sideways here, right? At the time this price moved higher from here, it can only happen because demand exceeds supply. Does that make sense? All right. Now, obviously with the supply-demand strategy, we can look deeper into these into this stuff and say, okay, you know, how out of balance, you know, are there things we can look at to quantify how out of balance supply and demand is here? Yeah, there are definitely, there's the evidence we can look at. And if you've been to one of these, one of the workshops, you've probably seen this, but how much time did price spend at the supply or demand zone? That helps us understand what the likely imbalance is here, right? The bigger the supply demand imbalance here, the more likely price is to turn and move higher. How did prices move away from the zone, right? Typically, the stronger price moves away from an area, the more, you know, the bigger the supply demand imbalance at the zone. Make sense? Okay. And obviously the big one is the location of that supply or demand zone. That is the big one. Okay. So the main thing we wanted to cover today is the concept of, how and why the stock markets are designed to go up over time. That's why we're so big on, making sure that we're very focused on where those significant demand zones are in the stock market. And not just the demand zones, but the supply zones also, right? And it's not like we don't have any supply in the market. In fact, if we look at the Russell, which is another big stock market, we can see that just the other day, blow this up. Here's the monthly chart of the Russell. You can see we just came up to, again, for the second time, came up to a larger time frame supply zone. And the fact that we're just touching this area suggests that there's quite a bit of supply here. So we would expect the market to move lower, from that area. Having said that, that equivalent supply zone in the NASDAQ, for example, is much higher. We're not even close to it at the moment, right? So the tech sector has quite a bit of room to rally, whereas the Dow and the Russell don't. Let's go to another big stock market. I guess we'll just make the stock market the focus today. We usually cover a bunch of markets. So for the DAX, right, and some of you that have been with us for a while, you probably remember this one. That's the COVID low in the DAX, right? And it always does, right? It takes really, really bad news to bring prices down to an outside the range fresh demand zone like that. But that doesn't really happen often, right? You don't get a COVID all the time. Now that we're coming back up to near those all-time highs, looks like we just over the past few hours ran into a qualified supply zone here. Kareem, yes. So it's not like one supply or demand zone is, when it comes to time, right? It's not like one time frame is more important than another, right? It's the location of the time frames that is the most important. Very important to identify supply zones in a market that's moving up, because again, the key is to identify think of it in terms of wholesale and retail. The demand zones are wholesale prices, the supply zones are retail prices. The more that we can focus on buying at wholesale prices and selling at retail prices, the better. Again, what most people do when they put money in the stock market, and I'm talking about the average person, is they just put money in the market and don't even think about price. They don't care about price, right? Or I should say they don't know to care about price. If they really understood how these markets worked, they probably would. It's a huge reason why your typical Wall Street firm or professional, almost always outperforms the individual investor that just has their money sitting in the market. Does that make sense? Okay. And another thing I thought we would look at. So let's go over here. Let's look at bonds for a minute. And I know most people don't care about trading bonds, and that's totally fine, right? But if you we can look right here. This is along the lines of the just pure supply and demand. So interest rates are pretty important to people, especially if you borrow money, for example, to buy a home, right? And I'm bringing this up because a lot of people think you have to be this financial wizard or major Ivy League economist to understand all this. But again, if you just have this razor sharp focus on supply and demand, and again, for those of you that have been in our sessions for a while, you probably remember that about 5-6 months ago, the bond markets came into a larger time frame outside the range demand zone, meaning this was prices are likely to turn here, which they did, and this has been the low in bond prices for the last 6 months, right? So, and I know most people are aware that interest rates are rising around the world, but not all interest rates, okay? I want to say it was November 10th of last year, which is right in here in this candle. This is a monthly chart, but right in here, for example, mortgage rates in the United States, mortgage rates, right? The rate that you, the borrowing rate when you buy a home, right? The interest rates for buying that home. That's what mortgage rates are in the United States, and obviously some other parts of the world. The high in mortgage rates was November 10th, I believe, which is right here. Remember, interest rates and bond prices are inversely related. When bond prices are moving down, interest rates are moving up. When bond prices are moving up, interest rates are moving down. So the bond market coming into demand means prices are likely to move higher, which they did, and interest rates are likely to fall, which is what they've been doing. Does that make sense? So even though you may have no interest in trading the bond market, which is fine, a lot of people do focus on interest rates in their personal lives. And this is the 10-year note. A move from 109 to 116 up here is a really, really big move in the bond market. And ever since we hit that, most of the interest rates that people deal with in their personal lives have been falling. So again, we can focus on the news, and all we keep hearing is interest rates are going up, 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 or we can have this razor sharp focus on supply and demand and get the, kind of the real and right answers as far as we're concerned, right? That can really help, in our personal life. That's what I'm getting at. Look, Kareem, what you're kind of getting at there is, which is true, is how you make money buying and selling in the financial markets is how we make money buying and selling in anything else in life. It's just average people don't understand that. They don't realize that, and they don't think like that. Does that make sense? All right. On that note, I know we are out of time, but anyway, I'll bring the screenshot up. If you want more information on the supply-demand strategy, you can always come to one of these workshops. They're free. But if you weren't aware of this stuff before, spend a little time thinking about it. It's a huge advantage when you have a market, that is inherently designed to move higher over time. But what this certainly doesn't mean is buy anywhere in the stock market. Okay. All these sessions are recorded, Adrian, and they are NFX Street posts them. Where they post them, they'll have to tell you. I don't know the answers to that, but yeah, and most people more people watch these recordings than attend these sessions live. All right, have a great rest of your day or evening wherever you are in the world, and we'll see you next time.